Well, it's time again for another monthly edition of the Rogers Capital Market Commentary, where we attempt to be the antidote to water cooler wisdom. Well, time flies when you're having fun. Hope you've had a great 4th of July weekend, some time with family, you're enjoying your summer, some travel, some relaxation. Man, we find ourselves now at the midpoint of 2024, which just sounds ridiculous, but we are more than halfway through 2024. June was another solid growth month on the stock market, 3.5% return for the month. That puts us at a 16.7% year to date, first half of the year, gain on the markets. You'll remember, many of you, that the average total return on a month, on an annual basis is 10% for the markets. So what should we expect for the rest of the year? Well, it's natural to expect that this can't continue, that it's time for a return to the mean. But historically, that's not what we see. Double-digit returns at the midpoint, so through the first half of the year, has happened 24 times since 1950. And what we see is 82% of the time, the year goes higher. So the second half of the year goes even higher after a great start, like we've seen. And it does so at an average rate of an additional 8%. In fact, only 4 times out of those 24, only 4 times has the market gone lower. And really only one of those was significantly lower. That was in 1987, the crash of 87. You may remember. You say, yeah, I hear you, but hasn't this been driven by tech? And yeah, it has. But if you take NVIDIA completely out of the market, calculation for the first half, you still see an S&P that's up 11%. You take the entire Magnificent Seven out, these big tech names that we hear so much about, Microsoft, Google, Apple, you take those out, you're still up 6% for the year. So not only has the market been higher, it's been broadly higher. As we've discussed, earnings has been the key. Profits is what drives markets. And yes, artificial intelligence, AI, has been a huge driver, but so has slowing inflation. While the risks to the U.S. economy persist, earnings, revenue growth forecasts remain strong. In fact, Bloomberg's earnings and revenue growth estimates for the index stood at 9.5% and 4.5% respectively for 2024. And they're now at 14% and 5.2% respectively for next year, for 2025. So any way you cut that, slice that, from at least my perspective, these forecasts, if they're met, the index should reward investors with even further gains. Now, that will not be without historical volatility. You remember, we've discussed it several times, that 3 numbers, right? 4 and 1 and 1 and 4. It's normal, it's historical for you to have a 5% pullback 4 times a year. We've had one of these already, but 4 times a year we're supposed to have a pullback. That's normal. You're supposed to have 10% correction. We've not had one of those in quite some time. We are due for that. That's normal. You should expect that. And then 1 and 4, every 4 to 5 years, we have a bear market. We've seen that a couple of years ago. But that's volatility you should expect. And so when that normal volatility comes due to election drama, we are we're in uncharted waters here. I mean, never before has the sitting president's party considered replacing him. So be it replacing him and nominating the sitting vice president, or changing that out, if that leads to some stock market drama, this historical volatility, you should expect that. Be it a hot inflation reading, a spike in inflation that causes some volatility, you should expect that. Geopolitical turmoil this summer, all of that, when it occurs, you can remind yourself, this is normal, it's expected. But the overall trend, this trend of earnings growth, should continue. And we still keep our eyes on the Fed. Markets are expecting a rate cut in the fall, at least one, maybe more, and then into next year, with eyes obviously on inflation between now and then. That's it for this month. Hope you're enjoying yourselves and get some good travel and relaxation in, time with your family. Stay cool out there. We'll see you next time.